gentlemen.
How's it going?
I'm doing great. How you guys doing?
Month of May.
Yeah, month of May.
We're around the corner.
Sometimes they say stay away, but we're not staying away. We're going to talk about it. So how did it look?
Yeah, you know what? Let's jump right into the month of May. You could say that maybe the headlines have slowed down a bit, but the market wouldn't have recognized that at all as we delivered a pretty robust return. If you're looking at the top 500 companies in the U.S. as measured by the S&P 500. 6+% to the upside, 6.29% to the upside as the top 500 U.S. companies delivered in May. That was great. And, my big thing is the momentum from the latter part of April just continued right into the month of May. So that was good. There's a couple things that we can unpack as we get into this a bit, but we also like to look at bonds. For those of you retirees, need a little bit of diversification. I would say stability, but less and less more recently with bonds. I mean, they're quite a choppy asset class, quite frankly. A lot of that has to do with the choppiness of interest rates. So if we study the bond market, we look at the aggregate bond index, and it's just going to be a basket of bonds, diversified basket of bonds. It's actually down 0.72% in the month of May. So, this is one of those months where bonds did not keep up. But think about it. Interest rates are they're correlated to debt. So as debt grows in the world, interest rates kind of want to follow it. And there's a lot that goes into that we don't need to unpack here today. But that interest rate volatility is what made it challenging for bonds. There are things we can do in portfolios, though, to, handle that type of volatility.
So did we do anything with portfolios and
Well,
kind of look back in the month and prepare for it?
Yeah, well, just go back and review some of our past broadcasts as we talk about portfolios. This interest rate volatility is not new. Yeah. We've not totally submitted to, thinking that it's going away. So, we've been handling it well in portfolios.
So, if we look at the market, we look at portfolios, and you kind of said we're not going to unpack everything, but I guess let's kind of look at one of the big things from the month, which was some of the, the trade deals, trade updates. Yeah. We won't use certain words.
Yeah,
but.
Yeah, no, definitely. When you look at the fact that China stepped up to the table, and actually there's some discussion and dialogue going on, that was very well received by the market. And I think that really, again, was what started the momentum on the latter half of April, and then again continued into May. There was a little bit of a hiccup there, are we going to get the two sides together? And we did see some fruit being bared in the month of May, at least with that China-U.S. trade talk. The other thing was a rather successful trip to the Saudi kingdom by the Trump administration. So that yielded some good headlines and perhaps some potential future investment in the U.S. and just deals getting done. Those were two good things. And just a little bonus clip that worked out well in the month of May was we heard the big tech companies and their earnings. And I think one of the things that's always been on individual investors' mind is this AI thing real? Is it durable? Did we overspend on AI investment on the front end of the kind of understanding of it? And one of the things that earnings told us was that, no, it is real. It is expensive to build out, and that these companies are going to continue to use that capital expenditure for these kind of AI advancements. So again, that was a nice thing that we learned from earnings season.
Nice.
Yep. So.
Well, kind of jumping back to, bonds being under a little bit of pressure in May. Something else that happened, the House passed the big, beautiful bill, right? Heading to the Senate. Yeah. Pretty large deficit spending in there. What are you kind of depicting from that bill? Obviously, it's not passed yet. It's got to go through the Senate, then to the presidency. But what does that look like, as far as, that kind of deficit spending? Are we seeing the pressure from the bonds in May kind of due to some of the bill being passed?
I think that there's some anxiety around it. So the way this stuff works is this bill makes it through the House, and then, the Senate is then there to say, well, this is how we view it. Mm-hmm. And then do they reconcile that bill with their thoughts? And then it goes to the president's desk. Okay. So it makes it through the House. That's great. But the problem is it doesn't do much with the deficit spend that we're seeing. And the deficit spending is when, as a nation, you're spending more than you're taking in. And think about it from a household level. Imagine, and this is kind of the idea behind the Trump administration's proposal of this big, beautiful bill. Mm-hmm. Imagine if, your household has $100,000 in income and $6,000 in credit card debt, and you kind of look at that and go, okay, pay this credit card debt down. Well, that's one way of doing it. You could take and start paying some of that off and not going out to dinner as much, whatever that might look like. But the Trump administration is trying to have individuals look at it differently. Imagine if it was, well, you know what? How about this? The salary is like the country's GDP. Imagine if you could go increase your salary, but it would cost you some money. So maybe there's a job opportunity that you have to spend $1,000 to get to. And theoretically, if you spend that extra $1,000, you should be able to double your income. So from the national perspective, our nation, grow your GDP. So let's say it works out. You got $6,000, you go to $7,000 in credit card debt, but now you've got $200,000 in income. Your ratios look better. But what if you don't get the job?
Yeah.
I mean, that's the risk that you're kind of up against here.
Mm-hmm.
So, and that's the thought process. If you're ever wondering why the Trump administration is bringing this to the table, that's the thought process. But certainly, the certain part of this is that we'll spend more and we would have more debt. Now, does GDP grow? That's the uncertainty. Yeah. So, yes, the bond market will certainly acknowledge the size of that bill.
Sure. And you know, when we're talking through that, you know, is that going to be good for investors? I think the argument is we're continuing to borrow from our kids and our kids' kids and the grandkids and future generations, right? And you know, how does that look from that perspective? And what are some of the things that we can do? I mean, from even an estate planning side of things, right? Going through like Roth conversions or contributions, how might that impact portfolio strategies, estate planning strategies?
So as you both are well aware, we check it down. What's right in front of us, that's what we play to. You know, and part of that is looking into the future and trying to understand, but how will the political world try to rectify this situation? There's so much that needs to get unpacked. But one thing is certain, you would expect that the country needs more revenue.
Right.
How does that typically come? You know, a tariff is just a form of tax. Mm-hmm. We've talked about that a lot. You know, so do taxes have to go up? In lies one of the ways we can add value to our clients. So Derek, you bring up just estate planning in general. We are not attorneys, but we've certainly been around the block and know what an estate should look like if you can describe to us what your wishes are. Mm-hmm. So we just have to be watching out for this stuff and think about, well, what is the easiest way for the government to raise revenue? Raise taxes. So we'll see how it all shakes out, but it does lead into some of the other things. We always talk about markets and portfolios. Mm-hmm. That's a tremendous way we can add value.
Well, right, and even staying on the point of estate planning, right? It's a good thing to always, you know, taking aside what's happening in the market, reviewing your beneficiaries. Do you have a trust in place? You know, powers of attorney are such an important piece, whether that's, you know, whether that's going to be for medical or financial. You know, how do you see that kind of impacting, you know, clients right now? Yeah. Is that something that we should be looking at kind of mid-year?
Yeah, well, you should always be looking at it.
Right.
And always have a game plan, something that we're working towards. Because then, you know, let's say, let's use the example of a Roth IRA. Mm-hmm. And think about that. Our goal there is to get as much growth as possible in there. So on balance, what you're going to probably look to do is have that be a little bit more aggressive and perhaps a traditional IRA be a little bit more conservative. When you look at both of them together, though, the client has a prudent allocation, but we're using the right silos for it. So there's just so much that goes into that. So I think just staying on it all the time and making sure you're in touch with your advisor about it, your team.
Right.
Yeah.
So, you know, we've kind of unpacked a few things, you know, with the markets and other things, but a big thing did happen at the beginning of the month, right?
Yes.
And I think, you know, since we've been in this industry for over 20 years, really since we were born to some degree, right? You know, a gentleman named Warren Buffett was at the helm of Berkshire Hathaway, and, you know, beginning of the month.
Retired.
Well,
And it did somewhat take investors by surprise. But I mean, quite frankly, he's been telegraphing this for a while. He's already got his successor in place. So Berkshire Hathaway will still live on, but it is a milestone in the world of investing, because the Oracle of Omaha, we all know. And so, you know, I've been very interested in Warren Buffett my entire adult life, and he's brought a lot to me and to my clients, quite frankly. So we just thought it was right to give him a testament and a nod, and
we gave him a whole bullet point.
We gave him a whole bullet point. There you go.
I think we all have, you know, used some of his sayings, whether that's in client meetings or otherwise, right? I mean, he's just been such a guru, such a, you know, staple for what we do.
Let's have one. Let's have a.
I kind of wrote down, you know, hey, it takes 20 years to build a reputation and 5 minutes to ruin it. You know, so when you think about that, you'll do things differently. And I think that's kind of a testimony to integrity, honesty, that fiduciary responsibility that we all have to our clients. I think that's such an important piece, and I think we all take that with the utmost seriousness and importance.
At its core, you wake up every day with that on your mind, and you know, Warren Buffett, just strengthening that in your mind, it goes a long way. And you know, that doesn't really necessarily even touch the investing side of things.
Right.
That's just how you live your life.
Yeah.
Morals and ethics are so critical, especially in this business here. So I'm going to just do the one that I always go to, and it's Wall Street climbs a wall of worry. And you've probably all heard me say that before, right? So impactful, such an impactful mindset to adapt to. And I even add my own little caveat to it. Wall Street climbs a wall of worry. Here's my part. And if there was nothing to worry about, that would be the worry in and of itself. So anyway, a lot there, and it's meaningful.
Well,
I know you had one too, James. I want to hear that one for the whole, you know.
My favorite one has has a lot to do when the markets are volatile, right?
Yeah.
So he always said, you know, you never know who's swimming naked until the tide goes out.
Yeah,
That's right.
True, very true.
So let's look ahead.
Yeah.
Right? We're looking at June.
Yeah.
You know, anything big going on there before we kind of let everybody go?
Well, let's just put it this way. You got to figure our financial hub is New York, and it's a seasonal environment, and it's less and less. I get it. But you've kind of created these things, the Stock Picker's Almanac. You'll typically see volume slow down in the summer months. Maybe the market gets a little bit less exciting. I don't know, though. The backdrop, there's a lot of headlines that can fly around. So I think we're going to have headline-driven market, obviously a lot of trade issues, certainly the showdown for the budget, that's going to be one. But, you know, we just got to watch liquidity, credit spreads, you know, how are earnings looking? I mean, it's just, I think the drumbeat will be pretty straightforward.
Well, what we always say is we'll be here for it, right?
You got that,
See
Rich.
everybody next month. Thanks for joining us.
Thanks.
Advanced Capital Management Incorporated is a registered investment advisor. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor before implementing any strategy discussed herein. Tax and estate planning information should not be construed as formal legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation. Thank you, and we look forward to seeing you next month.